Hey friends, welcome back to the channel. In this video, we're going to have a look at the 3 steps to insure your mortgage. Specifically, we're going to have a look at why you should insure, how much to insure, and what sort of products I would recommend. Let's get started. So the why is most important. We want to protect that asset that we've purchased. We might have spent so many years accumulating the amount of money to be able to make a deposit on a property so that our family can be happy, they're secured, or even if it's an investment property. We want to protect that asset just in case something happens to us. Unless you have enough money on the balance sheet to allow continued payments for mortgage payments, the bank may repossess that property at any time. So the why is very easy. It's basically the cost of doing business, in my opinion. Alright, so step number 2 is to have a look at how much we want to insure. And let's say we're purchasing a property for $1.5 million. So for simple math, let's call $500,000 your principal and $1 million the mortgage amount. This could obviously vary, but generally it's about 30% down, 70% mortgage, or 50% down in the case of an investment property and 50% mortgage. So if we have a look at it, that is the amount we want to insure. And it's very easy. All you have to do is have a look at a loan calculator. Any free loan calculator will give you this. And we input the amount $1 million. Let's call the interest rate about 2.5% for, let's say, 30 years. Now, the 30 years would depend on the age of the property and your personal age as well. And in Hong Kong, it's generally based on age 75 minus your current age. That's the maximum loan duration you can get a loan for. So in this case, the monthly payments are about $3,900, and usually these loan calculators also have a amortization table, which basically is the loan schedule. So it gives you the summary of if we were to get a mortgage for $1 million at 2.5%, monthly payments, you have principal and interest, and then each month what are the payments. So you're paying both principal and interest and slowly paying off the balance. So we started off with $1 million. After a few months it's still about $990. After a year we have about $975 left. 2 years, $950,000, so on and so forth. And you gradually get the idea and can forecast into the future. You know, for example, after 20 years, we're left with $416,000 still to be paid. So you can argue that you can forecast in the future, you know, if you're going to get different assets to be able to accommodate this risk or not, or if it appreciates in value. But the worst case is going to be the first year. And in the first year, we want to insure for that because that's the maximum risk. If something happens in the first year, and the mortgages are not being able to be repaid by the family's liquid assets in your absence, then the family would be forced to sell that property. So in this case, $1 million is the amount you should have a look at for insuring. All right, so step number 3 is to have a look at what we can purchase in terms of products to mitigate this risk. So in the insurance realm, basically there's different types of life insurance. And I've found that term life insurance is the simplest and most affordable way to mitigate this risk. So if we have a look at the table I created here, we get a feel of if the loan amount is 1 million US, and if we are age 30, 40, or 50, what are the costs? So generally, the maximum term for this kind of term insurance, as we define as level premium and then increasing premium, meaning that you are level premium for 20 years, level premium for 10 years, level premium for 5 years. The price doesn't change. Then it increases after that. We can actually see that, for example, a 30-year-old who has made this purchase can obtain a 20-year level premium life insurance for $1,160 a year. After that, it increases in price. And you can see that, for example, a 50-year-old, let's say he or she only wants a insurance for 10 years because they're going to sell it Basically, this is like a flip or something for an investment property. So that would cost level premium 10 years, $3,100, and then it increases after that. So it's a function of age. Before you turn that next birthday, you can lock in that level premium for that duration at that price. So obviously, the younger you are, the cheaper it's going to be. And also, obviously, the longer the duration, you're basically telling the insurance company you're wanting to secure this sum insured or this death benefit for such a long time at this current age. It's going to actually cost you a little bit more versus, let's say you only wanted to insure it for a very short duration, say 5 years, and have it increase after that, or have the insurance company be able to increase their premiums for you after that. Then that is actually the most inexpensive amount. So you get an idea. And you should sort of match this with the assets that you have, as well as the purpose for this property, whether it's for long-term hold, or let's say it's a flip, or it's an investment property. Obviously, you don't want to have this long-term. This is more for just for the property purchase. Let's call it a 30-year loan duration. So we want to maybe cover 20 years, have 10 years where we can think about another product, or reassess how much our assets are to be able to cover that associated risk. We may have more assets elsewhere, or the property has actually appreciated in value a lot, such that I can remortgage to shorten the mortgage. So there's a lot of creative ways, but I think to start at the onset, the first year, if something happens and you lose the property and the family is without this property, then I think that is the risk that is the most significant, and that is one that we need to mitigate. I hope you found this video useful on the 3 steps to insure your mortgage. In addition to property investment, if you wanted to check out how to invest in insurance products and why I think they're actually safer, check out this video over here. Thank you for watching, and I'll see you in the next one.